So I wanted to make a video where I talk about what's been going on in the news lately about the Federal Reserve pumping money into the, or should I say, the Fed conducting a repo operation where they're pumping money into the financial system. So I'm going to go through a few articles that I read and just my summary notes on everything that I've taken in so far with this repo operation. So earlier this week, the Financial Times wrote an article about how the Fed had to inject billions of dollars into the financial system. They noted that there was a squeeze in the short-term funding market, and at the time, repos had surged between Monday afternoon and Tuesday morning. Now, repos refer to repurchase agreements. This is the cost of borrowing cash in exchange for US Treasuries. Now, I did a little more research on that, and in a repo trade, Wall Street firms and banks offer US Treasuries and other high-quality securities as collateral to raise cash, generally overnight, to finance trading and lending activities. The following day, borrowers repay the loans plus some nominal rate of interest. When investors get fearful of lending, or when there is not enough reserves or cash in the system to lend out, it sends the repo rates soaring above the federal funds rate. Repos are a way for borrowers to raise short-term funding by agreeing to buy and sell securities over very short time frames. Earlier this week, the repo rate surged to as high as 10%, an increase of more than fourfold. This jump in the repo rate cascaded into the federal funds rate, which the Fed was targeting at 2.25% earlier this week. The federal funds rate was pushing to the top end of this range. For this reason, the Federal Reserve decided to engage in repo operations, and through this, the New York Fed made $75 billion available each night through a repo operation, or a repo auction. A repo auction is where the Fed accepts treasuries and other securities as collateral and provides cash to lubricate the system. Following the Fed action, the repo rate went back down to 0%. On Friday, the New York Fed added an additional $75 billion to the bank lending markets, bringing its four-day total to just over $275 billion. So why did all of this happen? Analysts say some technical factors caused this. They believe that corporations were pulling cash out to pay quarterly taxes, and a glut of treasuries created an imbalance, sending the repo rate higher. Jerome Powell, Federal Reserve Chairman Jerome Powell, addressed this week's spike during his press conference on Wednesday. He noted that the impact of tax payments and bond purchases on the system's 24 primary dealers was stronger than expected and surprised a lot of market participants. He went on to say, the strains in the money markets reflect forces that we saw coming, and they had a bigger effect than I think most folks anticipated. Strong demand for cash to purchase treasuries and pay corporate taxes. In addition, some economists even suggested that the weekend attack on oil production facilities in Saudi Arabia could have played a role in increasing demand for cash by foreign banks who were exposed to the Middle East. I think this was a shock coming from outside of the U.S. banking system, said Brian Bethune, an economist at Tufts University in Boston. Some analysts have also noted that bank reserves have been falling since 2015, when the Fed started raising interest rates. Reserves started to fall faster when the Fed began cutting its bond portfolio in 2017. Some policymakers wonder if the Fed cutting rates and no longer allowing bonds to roll off of its balance sheet is enough to stop the downward drift in bank reserves, which are the main source of funding in liquidity markets like repo. Primary dealers in the Fed system are taking down nearly $45 billion each day in gross US Treasury bond issuance, and reducing spare cash, known as excess reserves, at the same time. Those excess reserves have fallen by $171 billion this year, according to Fed data, and are down $1.4 trillion from peak 2014 levels. Now, analysts say that U.S. banks are much better capitalized now and have a greater amount of liquidity that shouldn't leave them vulnerable to the same shocks seen in 2008. Ashish Shah, co-chief investment officer for fixed income at Goldman Sachs Asset Management, described the moves in the repo market as a big deal. When things like this happen, it increases the uncertainty and leaves fixed income markets jittery. And that is the job of central banks to avoid, he said. Now, this is a story that I'm going to be paying close attention to going forward to see if these concerns about liquidity in the system persist over time. If they do, I think that's something that could be a huge drag on the economy going forward. So that's kind of my synopsis of what's been going on in the repo market and kind of a little background to help you understand what this means in the grand scheme of things. If you found this video useful, please like and comment down below. And if you want to see more videos like this, please subscribe to my channel. Until next time.